Positive pay is accurately touted as the best protection against check fraud. Positive pay is a fraud prevention service offered by banks. In addition to plain ordinary positive pay, there are variants including payee name positive pay and reverse positive pay, all of which we're going to explain in this short piece. So let's start with plain positive pay. This is how it works. When a company issues a check, it provides their bank with a list of all checks that have been issued. The list simply contains the check number and the dollar amount. The bank then compares this list to checks when they are presented for payment. If a check is presented for payment that is not on the list, the bank then flags it as a potentially fraudulent transaction and possibly contacts the company for verification before it pays. Alternatively, the company can instruct the bank automatically to reject such payments. Once the check is honored, the item is removed from the file, preventing criminals from representing the same item over and over again. Now, sadly, crooks quickly figured out what positive pay was and what the impact was, and they realized that the only thing they could do was change the payee name on the check if they wanted it to clear. So you guessed it, there was a surge in this type of fraud, check fraud, where the payee name was changed once companies started using positive pay in large numbers. The banking community responded by introducing a product they called payee name positive pay. And this included the payee name on the file, in addition to the check number and the dollar amount. Now, what if you can't create a positive pay file? Okay, then the banks addressed this issue with a reverse process. It kind of works in the opposite direction. Instead of the business providing a list of issued checks to the bank provides the business a list of checks that have been presented for payment, and this is presented every day. The business then reviews that list and flags any checks that should not be paid. Depending upon the arrangement with the bank, the items can be automatically rejected if that's what the company wants, or the bank gives them a relatively short period of time, usually 24 to 48 hours, to accept the item. You work this out with your bank. Use of positive pay, by the way, is not the only way to guard against check fraud, although it's one of the better ones, but it doesn't 100% protect you. Companies who put manual signatures on checks get some protection from that practice, perhaps not as much as they think, but only if the process is done correctly. However, frequently it is not. We recently did a video on all the poor ways that companies handle the signing of checks. You can watch it right now using the link that will appear momentarily on YouTube on your screen and is in the show notes below. As always, we appreciate your thumbs up, your comments, your shares, and your subscribes. Good luck.